Okay, let's get started. Welcome to Managerial Finance. I'm Dr. Mohammed Shushti, and I have been teaching at St. Xavier for 25 years now. Let me pass out copies of the syllabus. We'll spend a little bit of time going over the requirements for the class. I'm assuming most of you have already downloaded it from Canvas, but in case you don't have a copy of it. Okay. In case you don't have one, let me pass it out. You have one? Okay, let's copy the syllabus. Okay, once again, welcome to Managerial Finance. As you know, this is a required class in the MBA program, so everyone takes class similar to this in every MBA program in the world. My office is in 3911E. I don't know if you know the place. It's basically the strip or the building next to Gilhooly's. So Gilhooly's on 103rd Street. Okay. So my office is basically in a suite next to Gilhooly's. I've listed here my office phone number and also email. The best way to contact me would actually be email. If you send me an email, you can expect an answer the same day. And but obviously, if you need to talk to me, feel free to call and leave a message on my office machine, and I'll be happy to call you back. Office hours for now, tentatively, Wednesdays at 5:30 to 6:30 before class. If you need to meet with me, just let me know in advance. Sometimes I get here to the classroom early. We can always just meet here in the classroom, so you don't have to go all the way to my office to meet with me. Just let me know in advance, and I'll be happy to meet with you. I know for some of you that, getting here before 6:30 may be a problem. I'm always available to meet with you after class, so just let me know if you. Oh, you have one? Okay. So meeting with me should not be a problem. I can meet with you either before class or after class. And of course, if you have any questions, I'll be happy to answer them at any time. Just send me an email. So the textbook we'll be using is Financial Management by Brigham and Earhart. I assume all of you have this book already. It's 15th edition. It's a very widely used textbook, literally used in hundreds and hundreds of MBA programs, which is why the book is in its 15th edition now. There's a lot of material in the book, and we will go over a substantial portion of it during the semester. For further reading, I do recommend, this is a standard recommendation I make to all of my students, make a habit of reading something on a regular basis, maybe the Wall Street Journal, obviously, but depending on your profession or depending on your interests, some business publication on a regular basis. In the library, we do subscribe to a lot of academic journals. I've listed a few of them here. These are the most highly regarded journals in finance. Most of them are available in electronic form. So if you ever need to look up a journal, you don't have to go to the library. You can just log in with your ID and use one of the database services to access a journal article. Now, this is an 8-week class, and by definition, it's a hybrid class. So that means that in addition to actual classroom contact hours, there will be a substantial amount of time you will also have to spend online. And so I know some of you have already gone online and looked at the material. I assume everyone is able to log into Canvas, see basically the homepage. Okay. So as you will see, for each week, and for 8 weeks, and for each week, there are a certain number of things you have to do online. And you should really use Canvas as your primary resource right after your textbook for documents, tests, assignments, and so on. So the grading for this course will depend on quite a few things. Obviously, class attendance and participation is one of them. And in addition to that, you will also see for each week, there will be, let's see, let me click on week 1. For each week, you will have to answer, well, this gives you instructions on what to do, but for each week, you'll have to go online and typically answer a question. And so what I would like you to do is basically create an online discussion. And so for week 1, the discussion thread asks you to answer this question: how do you think the U.S. economy is doing right now? Okay, and the response is response and follow-ups will be worth 5 points. So you need to go online, post a response, read what other students are saying, or what your classmates are saying, and then also respond to at least one of them. Okay, and think very carefully before you answer the question. Don't answer it with 1 or 2 sentences. I would expect at least a paragraph or more as the answer to the question each week. Do remember that this is worth 5 points. So to get all 5 points, you do have to have a fairly detailed answer to the question. And also, when you respond to one of your classmates, again, read the classmate's answer carefully before you post your own response to that. So for week 1, as you know from the syllabus, there are actually 3 chapters assigned. So you actually have to answer 2 questions. One from chapter 1, which is the one about the U.S. economy. And then from chapter 3, after reading chapter 3, obviously, I would like you to post an answer to this question: are financial ratios enough to evaluate a firm's performance? And obviously, by the time you get to this, you have read the chapter, you have taken notes, and so again, take some time to answer, post a detailed answer to the question. Okay. So this is something you have to do every week. For each week, there will be 1 or 2 questions like this, depending on how many chapters we cover. If we do only 1 chapter, it will be 1 question. But since this is week 1, and we'll get to the syllabus in a moment. Since there are 3 chapters, there are actually questions from 2 of them here. So you do need to answer both of them. And okay. So in addition, there's also something called personal introductions. What I would like you to do is basically post something about yourself. I have posted something about my own background and interests and what I do here. And what I would like you to do is perhaps tell us a little bit about who you are, where you work, what your interests are. As you know by now, obviously, networking is a big component in every MBA program, so this is one way to make connections. Obviously, in class, we will have class discussions, but this will provide you with perhaps with a forum for more detailed discussions and so on. And so this is also worth 5 points. And again, post as much as you want. Obviously, I'm not going to force you to give out any personal information that you don't want to, but tell us something about yourself, your interests, where you work, and hopefully you'll start to make connections, start the networking process. Okay. So each week there will be instructions, assignments, and 1 or 2 discussion questions. The class attendance and participation, that's worth 5 points, and you don't have to do anything online. What I will do at the beginning of each class, and I'll do it today also, I'll pass out a sign-up sheet. What I would like you to do is just sign next to your name. That way I I have a record of who was in class, and so based on that, you will get those 5 points. Okay. So if you are not in class, obviously you don't get those 5 points. Okay. So you do have to be in class to get the attendance and participation points. Now, for each week, there's also a Q&A thread. Basically, these are questions you have after reading the material, or perhaps questions you have when doing problems. Just post. I'll try to check this once a day. Okay. So, right now, obviously, there's nothing there. But I'll try to check it once a day. If you have questions on the material, please post it here. I'll post a response as soon as I read it. And the way I'm doing it this way is because, your classmates may have the same questions, perhaps. So instead of everyone emailing me directly, I would prefer that you post it here, and that way everyone can see what the question is and also what the answer is. Okay. So we'll do this every week, or there will be one of these threads every week. And this one is for chapters 1, 2, and 3, which is what we will do week 1. Okay. Now, week 1 also has a lot more things here. Lot of items. Okay, for each chapter there are some learning objectives, basically an outline of some of the material in the chapter. It might help after you read the chapter or before you read the chapter to see what the objectives are. And each week there will also be a test. Okay, so instead of a long midterm exam and a final exam, you will be taking separate tests for each chapter. Okay. And so for week 1, even though we'll actually do chapters 1, 2, and 3, or most of 1, 2, and 3 today, for week 1, the only test you have to take is the one for chapter 1, and that has to be completed by June 4th. Okay. So for week 3, I'll actually give you one additional week. For chapter 3, we'll get one additional week, so there will actually be 2 tests next week. And have any of you taken tests online using Respondus? Not yet? Okay. So you do have to download and install the Respondus software. Okay. I have posted instructions. It's basically on Canvas. You click on some links. You do need a computer with a camera and a microphone. I'm not sure whether you will actually need the microphone, but you do need a laptop or a computer with a webcam. And the Respondus software, you'll have to start it and then select the exam. And basically it locks up your computer. It won't let you do anything else. It'll take a video of you taking the test. Okay. So there's a separate test for each chapter. So the average test is about 30 to 45 minutes long. It will record, as I said, it'll make a recording if you're taking the test. And there are a few other instructions it might ask you to do. I forget what they are, but I think it asks you to basically show there's no one else in the room and something like that. Make sure that you're the only one taking the test. Okay. But you do have to install the software, make sure it's running. So because the first test is due June 4th, I would not wait until June 4th to download Respondus. I would just download it a few days early, make sure it's working, and then when you're ready, just start the test. So that's going to be required for every test. You will have to use the Respondus software to take the test. Okay. And so all of the tests in this class will be taken online. Okay. And so there will be no in-class exams. The advantage is you do get more time to study the material and take it at a convenient time for you. Okay. So week 1, I've also put up, well, you will also see on Canvas the slides for each of the chapters that we will cover in the syllabus. And also, there are problems at the end of each chapter. And we will do, in class, we will always do a few problems. In the syllabus, there is also a list of recommended problems. I would like you to do all of them on your own. And in case you get stuck or if you wish to check your answers, I've also put up copies of the solutions. Okay, so the solutions to all of the solutions and answers to all of the questions at the end of the chapters are there. So feel free to use them. Couple of other things, the Canvas student guide. I'm sure all of you are familiar with Canvas by now, but in case you need it, I've provided a link there, link to Respondus installation, and then I've done this only because students in other classes have asked for it. You will have to use a calculator, obviously, for the calculations. If you have a financial calculator, very good. If not, don't worry about it. Really, any scientific calculator will also work in this class. So, I don't own any of these calculators, but these are some of the more commonly used ones. And so what I have done is collected instruction manuals to some of the more widely used ones, and I've put them on Canvas. So if you have one of these, for example, at TI-83, or 84, which one do you have?
84.
84. Okay, so if you have a TI-84, which is very, very widely used, it's not a finance calculator, it's a scientific calculator. However, it does have a lot of finance functions built in. So for some of the problems we will do later, the built-in finance functions will save some time. But if you don't have them, don't worry about it, because we will be using the actual formulas in class, and in class you will see how to use the actual formulas. So really, any scientific calculator is fine. You don't need a finance calculator, but if you have one, it will help. And so again, I don't own these calculators. I just collected the instruction manuals online. Most of them are available online, obviously. So I've put them up, so in case you need to look up something. So, some people don't know that TI-83 and 84s actually have finance functions built in. I don't know if you have used them, but so they are there. You just have to read the manual and figure out how to use them. Okay, so. All right. So again, resources you might want to use, and a couple of external links. The Careers in Finance, website that talks about some of the career options available to people in finance, and also some links to job sites. Again, this is external, nothing to do with St. Xavier. The CF Institute, that is something I would recommend checking out. If you are a finance major and you plan to work in the financial services industry, then one of the things you should think about is sitting for the CFA exam. CFA stands for Chartered Financial Analyst. There are 3 exams you have to take over, I think, roughly 2.5 years. They do go far beyond what we cover in this class. Okay. But if you plan to work in the industry, I would recommend you think about getting this certification. Okay. Remember, if you're an accountant, you sit for the CPA exam. Here in finance, this is the gold standard. But the exams are very difficult, very challenging. But if you plan to work in the industry, this is one way to certainly make yourself well, let's say marketable. Okay. So check it out, and we can talk more about this later. So week 1, I put up a lot of stuff. You don't have to look at everything, but just look at what's needed. And so each week, okay. So each week, starting with week 2, this is what you'll see instructions, assignments, and discussions. So obviously there will be 1 or 2 questions for you to answer and then also respond to one of your classmates' responses. The attendance and participation part, I'll just give you 5 points if you are in here in class. And then, of course, Q&A thread. If you have any questions, post your questions there. And just as before, learning objectives, tests. Now, for next week, as you can see, there are 2 tests. One for Chapter 3, which is actually what we'll do today. But I thought I would give you some time to do the problems, read the material. And then next week, we will also go for Chapter 4. So you will be tested on Chapter 4 also. And notice that the deadlines are, well, for both exams are June 11th, okay, which should be Sunday. Okay. So roughly for each week, you get, well, let's say 4 or 5 days study. Now, so that's week 2, and this continues until week 8. Okay, and so we end the class in week 8. Okay. One more thing I added in week 8 is this thing called learning reflections. A couple of questions about your experience in the class and what you have learned and what you plan to do with it. And so that's also worth 5 points. I hope you'll consider answering those questions. Okay. Okay. So what this means is that you are going to be spending a certain number of hours each week online. Okay. The online discussion plus obviously the online tests. Now about the tests, I did put down a few things here, but let me just explain how the tests will work. There's a separate test for each chapter, and the questions are all multiple choice. Okay, and depending on the chapter, you will probably see a few conceptual questions, and then a bunch of problems. Okay. Now, Chapter 1 does not have any problems, so Chapter 1 is all conceptual questions. Okay. And after that, most chapters will focus on problems, so there will be a few conceptual questions, but there will be a lot of problems from those chapters. Okay. Now, obviously you will take the test at home on your own. You are not allowed to get help from anyone. Here's what I will allow you to do. You are allowed to use 1 page of notes for each chapter. Okay, 1 page means basically 1 sheet of paper. You can write on both sides. You can write anything you like, anything you want. I would recommend that you do put the formulas in there. When we do have problems in chapters, you will need the formulas, okay, to do the problems. So for the test, for taking the test, you need your 1 sheet of notes and a calculator, and the tests are not the same length. Some are a little bit longer than others. Make sure you keep track of time. You'll have to work quickly and efficiently, and remember that everything is multiple choice. Okay, and also once you start a test, you cannot pause it. You have to finish it. So 30 minutes, 45 minutes, or 60 minutes, however long the test may be, once you sit down, you do have to finish it. Okay. So when you prepare your 1 page of notes, do think very carefully. Obviously, you will need all the formulas to do the problems, but anything else you want to write, that's fine. Outline the chapter, important models or topics from the chapter, that's fine, but 1 page. Okay, so 1 page of notes, and so that should help you with the tests. But you do have to work quickly and efficiently. Okay, so be careful with the time. Make sure you keep track of time. Okay. So, how do you study the material? Once again, I have been asked that question a number of times. So, I did put in a section called Recommended Study Habits. Basically, you do need to read the entire chapter very carefully. And I recommend that when you read the chapter, when you read the textbook, take notes. Okay. Some people do an outline. Some people do an outline plus additional material, but take notes when you read the chapter. Okay. And then obviously the PowerPoints are available on Canvas. The solutions manual is available on Canvas. So after you have read the material, there are questions at the end of the chapter. There's some, for example, there are short answer questions. I would recommend going through the questions, see if you're able to answer them. Okay? Because you will get some conceptual questions related to the text material. And then in the syllabus, you will see from each of the chapters, I've also recommended some problems. So in class, we will do a few problems, but I would like you to do the rest of them on your own. And the exam problems obviously will be similar to the ones in the book. Okay, nothing on the exam is going to come as a surprise. The problems will be similar. I guess I can say this. Your book does have a lot of complicated problems, or complex and long problems. You will not see complex and long problems on the exam. Okay, so exam problems are going to be relatively short because of the time constraints. There will be a lot of problems, but a lot of short problems. Maybe a few, one or two longer ones, and of course conceptual questions. Okay. Now, the conceptual questions are a bit tricky. So some of them are. Some of them deal with descriptive material, which is fine, but some of them ask you to use a certain concept covered in the text. Okay. So, for example, in the textbook, there might be something about, well, this is chapter 1, but let's say something about economic growth. And the question might be, if the economy is growing, what do you think will happen to interest rates? In a growing economy, what happens to interest rates? They usually increase. Yeah. Why? Supply and demand, right? In a growing economy, there's a demand for money, so interest rates go up. Okay. So some of the questions, not all of them, but some of the questions are sort of like that. You have to apply the knowledge or apply the concept from the chapter and use it to answer the question. Okay. So lots of problems. Obviously, you make sure you have the formulas. You are going to need the formulas in order to do the problems. Okay. Now, let's see, what else? Statement of academic honesty. Obviously, you've seen this before. This is the standard university policy. All of the work you do has to be your own. That applies to any responses you post online. And obviously, the exams, you will have to do them on your own. You cannot ask anyone for help or use any kind of help. Okay, so standard policy. Now, page 4 of the syllabus, I've given you links to some online data sources. You really are not going to need them for this class, but I would ask you to look at some of them. If you're interested in doing research or getting perhaps a little bit more information on a certain topic, there are a million online sources out there. These are just a few. But again, obviously these are all free sources of information. I would recommend you browse through some of them. There are also a lot of online videos, and I've provided links to some of them. A few of them will cover the material that we go over in class or go over in this course, but there are lots of videos about other topics in finance. And again, this is assuming you may be interested in majoring in finance. You may be interested in additional topics maybe not covered in this class. So the videos do go over quite a few of those finance topics. So semester plan, we will try to stick to this as much as possible. It is an 8-week class. We do cover a lot of material in 8 weeks. So for first week, I've listed chapters 1, 2, and 3 in the syllabus. Now, chapter 2 is marked read-only because chapter 2 reviews financial statements. Okay. Now, in this class, we do assume you are already familiar with balance sheets and income statements. Okay, so you know what they are, how they're prepared, how they're used. In case it has been a while, I would recommend going through chapter 2 very quickly, maybe skim over the material to refresh your memory. But chapter 1 basically is an introduction to the book, introduction to the financial environment, and it's all descriptive material. We will not go over it in class, okay? But I would like you to read it on your own, look at the PowerPoints, and then take the test, okay? So the first test will cover only chapter 1 and a lot of conceptual questions from chapter 1. Okay. So what we will do today is actually go over chapter 3, which deals with financial analysis, okay? More specifically, financial ratios. Okay, so we'll do chapter 3 today, and as you can see, recommended problems 3-1 to 3-13. We will do a few of them in class today, but I would like you to do as many as you can on your own. So one of the things that financial analysts do is analyze performance of companies, and most of the time you are dealing with financial statements prepared by those companies, balance sheets and income statements. So in this chapter, what we will do is learn a little bit about ratio analysis. Most of you are probably familiar with financial ratios, have seen them before or encountered them before. They're very easy to calculate, but they can be very effective in evaluating a firm's performance, as we will see. So we'll learn about financial ratios and ratio analysis, and then also take a look at some of the other issues related to ratios. Okay. Now, this is something we will actually do much later, but in finance, one of the things we use in valuation of companies is this model. This is sometimes called the intrinsic value model, and this can be applied to entire companies. This can be applied to any financial asset. Basically, the definition is that the value of the asset, value of the company, or value of the security we're looking at is equal to the present value of the cash flows you expect to get from it. So this particular equation here is looking at an actual company. And right now, obviously, you may not know what weighted average cost of capital is, but we will go over it in a later chapter, or in a chapter later this semester. And so this is a standard assumption we make, that the value of a company depends on the cash flows of the company. Okay? And so we will learn how to do this in a later chapter. And so what the authors of the text would want to do is give you an idea of where the information comes from and some of the factors that have an impact on FCF, free cash flow. And so we'll obviously look at this in much more detail in a later chapter. Okay. Now, before we get into ratio analysis in more detail. Let me make up a simple example. Okay. Let's suppose you're looking at two companies. We'll just call them Firm A and Firm B. And by the way, in this textbook, the words company, corporation, firm are basically used interchangeably. Okay? The textbook basically assumes we're looking at a corporation or dealing with a corporation, and but the word firm is used, company, the word company is used, or sometimes just business, but they'll assume you're dealing with a corporation. Okay. So let's suppose you're looking at two companies. We'll just call them Company A or Firm A and Firm B. And perhaps you're looking at an income statement and look at the bottom line, which would be net income or net profits. Okay, these are just made up numbers. So let's assume that Company A or Firm A has reported profits of 100 million. Company B has reported profits of 200 million. Okay. Now, if you're looking at just the raw numbers, does this mean that Company B is twice as profitable as Company A? Or twice as efficient? Now, profitability is not something we have not defined yet. Think of it as efficiency. Okay? Profitability, how efficient a company is at generating profits. So if you look at the dollar amount, and the dollar amounts are 100 million and 200 million, does this mean that Company B is twice as efficient, or twice as profitable? No? Why not?
Because their revenues could be a lot higher than, let's say 1,000, and other companies' revenues could be 200.
Okay. So the amount of profits, then those numbers by themselves don't really tell you much about efficiency or profitability. Okay, you have to put the numbers into perspective. So one way to do that is by perhaps looking at the size of the company. And firm size can be measured in a number of ways. For example, you can look at annual sales, which is a very commonly used measure. Okay. But obviously there are other ways to do it. You can also look at market capitalization, maybe total assets, number of employees, or something like that. Again, it depends on the context, what it is you're trying to calculate or analyze. So just because this number is twice as large as this number does not mean that this company is twice as efficient or twice as profitable as Company A. So you do need to put the numbers into perspective. One way of doing it is by looking at sales. And so let me make up some numbers. Okay, now we have some perspective. Company A has sales of 500 million. Let's assume this is annual sales. Company B, sales of 2 billion or 2,000 million. Now, if profitability is efficiency, kind of efficiency which it is, which company is more efficient at generating profits? Company A or Company B? Okay, you said Company A because?
Less expensive.
Well, they generate 100 million in profits with 500 million in sales. This company's sales are 4 times more, but they're generating only 200 million. Yeah. So, obviously, one way to make the determination is by converting the information into a ratio. Okay? And one ratio, which is very widely used, is net profit margin. Okay, and this is net profit margin. You take net income, divide by sales. Okay, so this is net profit margin. And so if you take 100 divide by 500, you get 0.20. Here you get 0.10. In decimal form, that's what it is, 0.20 and 0.10. You can also convert this into a percentage. Okay. And so the net profit margin for company A is 20%. Net profit margin for company B, 10%. Okay. And so now we have converted the information into a ratio which enables us to determine which company is more efficient at generating profits. So obviously this is a profitability ratio. Higher the number, the more profitable the firm is, which also implies the more efficient the firm is at generating profits. Okay. So basically, this is what ratios enable you to do. Make meaningful comparisons, use data from balance sheets and income statements, convert them into a ratio, which enables you to make that comparison. And from that, you can determine which company is more profitable or less profitable. Now, the questions? So the numbers again, with ratios, you always have to compare. The 10% or 20% by itself doesn't really mean much, but you have to compare it. So when you evaluate a company's performance, you compare it to another company, or you compare it to an industry average. Okay, so industry averages are widely used as benchmarks. So this is one type of comparison. You compare one firm against another. Now, this could also be perhaps a comparison at 2 points in time. Maybe this is 2017, and this is, I'm just going to make up a number, let's say the year 2012. Okay. Same company, 2 different points in time. So if you're looking only at sales, you would see sales have quadrupled in 5 years, okay, which is a remarkable growth rate. You're not going to see this kind of performance very often. So this is good. Sales have quadrupled. If you look only at profits, you would see profits have doubled in last 5 years, which also seems good. But once you convert it into a ratio, then you see that maybe things are not as good as they seem to be by looking at the raw numbers, because your net profit margin is actually down from 20% to 10%. Is that a significant decline? Yeah. Should the company be worried? Yeah. Now, sometimes this happens because of problems at the company, maybe bad management. And then sometimes there may be extenuating circumstances. This could be, again, remember I just made up these numbers, but this could be during a period of economic expansion. This could be during a serious recession. So, sometimes there may be extenuating circumstances, but whenever there's a change, obviously, or decline like this, you need to be worried about it. Okay. So, again, that's why we use ratios, because the numbers by themselves don't really enable you to make comparisons or meaningful comparisons. But once you convert it into a ratio, you can get a lot of useful information. And so, depending on who's doing the analysis, if it's a bank or a lender, ratios are often used to determine the creditworthiness of a company. There are credit rating companies which use proprietary models to come up with numbers, credit scores for companies, just like they do for individuals. And many of the models are based on financial ratios, or they use financial ratios to come up with a credit score. Internally, companies also use ratios because they can identify areas of strengths and also areas of weakness. Okay, obviously, you would be more worried about areas of weaknesses because you need to get rid of them, you need to deal with this, and obviously, if you have areas of strength, you would also like to build upon those areas. Okay. So ratios are very widely used, many different ways, sometimes internally, but also by external analysts. So we'll take a look at some of the more commonly used ratios and just a quick look at a highly abbreviated income statement. Most income statements obviously start with sales, and then typically you would have cost of goods sold, maybe other costs. Depreciation is usually separated out, and after all the costs are subtracted, you end up with EBIT, earnings before interest and taxes, and then interest expenses, which gives you EBT, pay taxes, and then you get net income. Now, this is a highly abbreviated income statement, but these are typically the numbers you would use in ratio analysis. So it's sort of an analytical income statement. Okay. Balance sheet. This is the left-hand side of the balance sheet, which will have current assets and fixed assets. Okay. And again, you're looking at a highly abbreviated version of a balance sheet. Okay. By the way, what's the definition of current assets?
Liquid.
And what's current versus long term? Okay. This is long term, right? Fixed assets are by definition long term assets, and cash, receivables, inventories, they're considered current assets. And the same definition applies to. Okay, that's one way to look at it. How about liabilities? I mean, same question can be applied to liabilities. Right? Current liabilities, long-term liabilities, and equity. So what's the definition? What makes something current versus long-term? Current assets or current liabilities? What's the definition in terms of timing?
Less than
Yeah, yeah, exactly. So 1 year or less. The maturity of the liability or whenever the liability is due has to be 1 year or less. Anything more than that is considered long-term. Okay. So that applies to both assets and liabilities. Okay. So again, you're looking at a highly abbreviated balance sheet. This is the right-hand side of the balance sheet. Okay, so current liabilities. And okay, so we have current assets and fixed assets, which add up to total assets, current liabilities, long-term debt, equity. And of course, total assets has to be equal to total liabilities plus equity. Okay. So, obviously we'll be using balance sheets and income statements in some of the chapters. We will be looking at this in more detail perhaps later on. One thing I would like you to remember, this is the left-hand side of the balance sheet. So this is where the assets are. And on the right-hand side of the balance sheet, what you are looking at are the sources of financing. So liabilities and equity, these are the sources of financing used by the firm. Okay? So basically the right-hand side of the balance sheet finances the left-hand side of the balance sheet. Okay, so you have assets on the left-hand side of the balance sheet, both current assets and fixed assets. And on the right-hand side, what you are looking at are the sources of financing used to purchase those assets. Again, we will We'll look at this in more detail in later chapters, but that's how you should be looking at balance sheets. So, financial ratios are typically divided into 5 categories, and first one we will look at are liquidity ratios. So these ratios enable you to determine the ability of the company to service its short-term obligations. Okay? Short-term obligations would be bills that you will have to pay within the next 12 months. Okay? And two of the most commonly used liquidity ratios are current ratio and quick ratio. Okay? So current ratio is always calculated by taking current assets, dividing by current liabilities. And then quick ratio, this is a more conservative measure of liquidity. You subtract inventory from current assets before dividing by current liabilities. Now, why do you think we subtract inventories? Well, remember the ratio, the liquidity ratios calculate how strong the firm is or the ability of the firm to meet short-term obligations. So basically, you're converting current assets into cash to pay off the current liabilities. And if you look at current assets, in most industries, for most firms and most industries, inventory is the least liquid asset you have. If you need cash in a hurry, it's hard to sell all of your inventory and generate cash. Now, there are exceptions. But for most industries, most companies in most industries, inventory is considered the least liquid asset, so that's why inventories are taken out. But as I said, there are exceptions. Okay? So think of an industry where you can actually sell your inventories very quickly to get cash. What would be an example? Let me give you a hint. Think of global industries, something, a global product or global industry, so that any time of day or night, if you wish to sell, you can sell it, get cash. Maybe not that quickly. Sometimes yes, but more liquid than that. What can you sell globally? Anytime, middle of the night, you want to raise $1 billion, you can sell it, get $1 billion. What would be an example of something that you can sell that quickly? Yes? Think globally. Something that's traded globally, bought and sold globally, 24 hours a day, in large amounts, obviously.
Oil.
Yeah. Okay, oil would be one example. It doesn't matter whether it's crude oil or refined oil. There's a global market for it. If you wish to sell 1 million barrels, you can find a buyer in a few seconds, maybe a few minutes. Okay, so that would be one example. Other examples? Maybe, but any amount, any time?
There's a buyer for everything.
No, there is. There's a buyer for everything. For certain products like commodities like oil, other examples would be precious metals like gold, silver, platinum. There are global markets which operate 24 hours a day. And that's also actually true for some financial assets also. Treasury bonds, treasury bills, currencies, you can sell You can buy and sell them on any amount you want. You can buy and sell. Okay. So for those industries and those types of companies, this would not really be a more conservative measure of liquidity. Okay. But again, most companies, most industries, inventory is usually the hardest one to convert into cash quickly. And so now these are very widely used liquidity ratios. There are more, but these are the ones which are most widely used. Okay. Okay, and as the example here, what they do is they give you 3 years of numbers. So you do compare, you do see what the trends are for that particular ratio. And then, of course, you also compare to the industry average to determine how the company is doing. Okay. Now, asset management ratios, this is the second category. Obviously, these tell you how effectively or efficiently the company is managing its assets. And there are 4 which are widely used. Okay. Inventory turnover tells you how effectively or efficiently company is managing its inventory or turning over its inventory. And once again, the number by itself doesn't really tell you much. You do have to compare to an industry average. Okay. In this example, the company is not doing as well as the average company in the industry. Okay. Now, obviously, if there's a problem, you need to investigate why their inventory turnover is much lower than the industry average. And so depending on the company and the industry, there may be a number of reasons. These are some possible explanations. Maybe they have old inventory that no one wants to buy. And inventory might become obsolete, might deteriorate. And so again, depending on the company, you do need to investigate. Okay. Second one, DSO, days sales outstanding, sometimes also called average collection period. This basically tells you on average how long it takes the company to collect on its receivables. So receivables divided by average sales. In this example, company takes 45 days. Okay. And the industry average is 32 days. So what's wrong with the delay? Company's taking 45 days, industry average is 32. So specifically, why is that a problem for the company?
Customers are having trouble paying or something?
Okay, but for the company, why is it a problem if you have to wait a long time to get your money?
So you can't pay off.
Basically, you don't have the cash. So you are not able to use it to pay your bills. You are not able to use it to maybe pay off debt. So any delay, any kind of delay with getting cash is bad from the company's perspective. Okay. There are a couple of these asset management ratios which look at fixed assets and total assets. And basically what these numbers tell you is how effective or how many dollars of sales the company is generating. Here with total assets, company is generating $2 in sales. With fixed assets, company is generating $8.41 in sales for each dollar of fixed assets. Now, once again, you do need to compare against an industry average for the numbers to be meaningful. And so for the fixed asset turnover, the company is actually overperforming. But when it comes to total asset turnover, they're generating $2 in sales. Average company, $2.50 in sales per dollar of total assets. Okay? So the company is underperforming. Okay. So again, remember, ratios are very easy to calculate, but for them to give you useful information, you have to compare, and usually compare against an industry average. Okay. Debt management ratios, there are actually two types of debt management ratios, leverage and coverage. Okay. And this is an example of a leverage ratio. Depending on the book, textbook, or maybe depending on the financial analyst, the debt ratio may be defined in several different ways. This is one example. Here you're looking at total debt to total assets. Okay. So basically this tells you what percentage of the company's assets are being financed with debt. Okay. So again, remember, this is a leverage ratio. You're looking just at leverage. Here's another example of a debt ratio. Here you're looking only at liabilities. You're looking at total liabilities over total assets. Okay. Now this is a coverage ratio, TIE times interest earned ratio. And again, this is probably the most widely used coverage ratio. This one measures the ability of the company to service its long-term debt obligations. Okay. So typically you would have annual interest expenses, and you would take your EBIT divided by annual interest expenses. So in this case, the company has a TIE ratio of 6.3. It's a very simple ratio, but very, very, very widely used. Okay. And this is an example of another coverage ratio. This one is much more elaborate. This does take into account other obligations that the company might have, okay, such as lease payments and loan payments. So you have not only interest expenses, but other payments that the company has to make during the year. Okay. Okay. So again, the debt management ratios tell you something about how the company is financing its assets, and also the ability of the company or strength of the company to meet those obligations or annual obligations related to debt. Okay. Now, profitability, think of profitability as a kind of efficiency, or efficiency with many dimensions. And there are a whole bunch of profitability ratios which we use to determine how well the company is performing. Okay. Net profit margin, which we looked at in this simple example here. So net profit margin, operating profit margin, both of these are based on numbers you get from the income statement. Okay. Gross profit margin, also calculated numbers from the income statement. With ratios, it's always important to look at trends so that you have multiple years of data and also some kind of benchmark. And so the industry average usually used as a benchmark. Okay. Basic earning power, EBIT over total assets. And this one is helpful because it removes the effect of taxes and leverage. Okay. And the final two, return on assets, return on equity. These give you overall measures to evaluate performance. Okay. Return on assets. And we'll look at the DuPont ratios in a moment. But financial analysts working for the DuPont Corporation came up with a system many years ago to evaluate company performance based on ratios or using financial ratios. And they argue that ROA, return on assets, and return on equity are the two most important ratios if you wish to evaluate management performance or company performance. So return on assets tells you how effective or how efficient management is at generating profits from the company's assets, all assets. Okay. And ROE tells you how efficient management is at generating profits from the shareholders' investment, owners' investment in the company. Okay. So they argue that these two are the most important financial ratios when evaluating performance. Okay, and obviously these are all profitability ratios. Okay. Now, market value ratios are completely different from the previous categories. So we have looked at liquidity, asset management, debt management, and profitability. So those four categories use numbers provided by the company, or basically looking at using internal numbers. The market value ratios now basically tell you how the stock market is evaluating your performance. Okay. And so some of the more commonly used market value ratios we look at are PE ratio, or price to earnings, price to cash flow, market to book, or market value to book value ratio, and let me explain exactly how this works. In the stock market, this is how we value a company, right, based on stock price. Okay. So the stock price of a company, this is one model, but this is how we think it works, depends on two things: EPS times PE ratio. Okay. Now, what you have here is earnings per share, and the PE ratio is actually price per share over earnings per share. So earnings and earnings cancel each other out, leaving you with price on the right-hand side. Okay, so mathematically that's how the left-hand side is equal to right-hand side. But here's how the thing works. And again, I'm just going to make up some numbers. Let's suppose a company reports earnings of $2 per share, and the stock market decides this is worth maybe 15 times. So the stock market gives you a P ratio of 15. And so you see an observed stock price of $30 a share. Okay. Now this number depends on management ability. How good management is at running the company. The PE ratio, this is just a number or a multiple awarded by investors in the stock market. Okay. So this is a multiple, let's say, awarded by stock market. So the ratio is kind of a grade. If the stock market likes your company, you will get a high P/E ratio. If investors in the stock market don't like your company too much, they will give you a lower P/E ratio. So, you can easily, I'll make up some numbers. So this could be company A with a stock price of $30 a share. Company B might be a similar company with the same earnings, $2 a share, but the stock market might decide to give it a much lower valuation. And so that company could end up with a lower stock price. Why the difference? Well, it could be due to many different reasons. For example, company A might have better management, maybe better products, better prospects, better reputation. Okay. Company B, maybe not so much. So this is how the market differentiates between good companies and bad companies, or better companies and maybe not so good companies. Okay. So that's where the market value ratios come in. The market value ratios are sort of grades given to the company by investors in the stock market. Okay. So the better the company's reputation, maybe the more liked the company is in terms of management, products, employees, reputation, ethics, whatever the reason may be, those companies will get higher P/E ratios. So, company A and company B could be similar companies, same industry, doing the same thing, but this company, for some reason, the stock market likes this company, they will end up with a higher stock price and higher valuation. Okay. And so this is one example. And the other ones you saw, cash flow per share, market to book, they work the same way. So you would have cash flow per share times a price to cash flow multiple on this side, or you could have book value per share times a market to book value ratio on this side. And regardless of which one you're using, the multiple is a grade. So you can use the multiple as a grade. The higher the multiple, the more liked the company is by investors in the stock market, and therefore the more highly valued the company is in the stock market. Okay. So the previous four types of ratios just deal with internal evaluation. You are looking at evaluation of internal performance. The fifth category, market value ratios, now give you market valuation, or let's say market evaluation. They tell you what the market thinks of you, or how highly the market thinks of your performance. Okay. So, these are the most widely used ratios, and if you have the textbook, let's take a look at a few things here. Turn to page 120. Figure 3-2. This is just an example of a graph. This is return on common equity for a company called MicroDrive. And what you are looking at here is 5 years of data with the company compared to the industry average. And so this is a fairly standard approach. 5 years, if you have multiple years of data, the advantage is you can then see if there are any trends. Okay. Sometimes trends do exist, and you need to know whether the company is on an upward trend or downward trend. And of course, you always need to compare against the industry average to see how they're doing. Take a look at page 119, table 3-1. this gives you a complete list of all the ratios we have looked at so far. And let me make a couple of comments about ratios. These are the most widely used ratios, but there are additional ratios which are used by financial analysts. Okay? And sometimes analysts will make up their own ratios, customize the ratio. But you should know that there are other ratios which are used by financial analysts. And depending on which textbook you look at or which analyst's work you look at, some of the ratios may be formulated slightly differently. Okay? So we don't really have standardized definitions for all the ratios. Okay, so for a few of them, for example, debt ratio, depending on who's doing it, can be defined differently. Okay. So again, sometimes minor differences, sometimes not, but you do need to be aware that there is some variation depending on who's doing the analysis. Okay. Now, because the ratio, remember the definition of ratio is whenever you divide one number by another, you're getting a ratio. So there are other ways to convert balance sheets and income statements into ratios. And here's one way to do it. You basically construct common size balance sheets and income statements by taking each number and dividing it by the total. So for example, in this case, all of the assets are calculated by taking the number and dividing by total assets. So every asset is now a percentage of total assets. Okay. So depending on the context, this might give you useful information about a company's performance. And so, for example, you can look at trends in the numbers and see whether the company perhaps has more cash than before, or more receivables than before, or using more inventory than before. But you do convert everything into a percent of total assets. Okay. So that was the left-hand side. This is right-hand side of the balance sheet, so everything is a percentage of total liabilities and equity. Okay. You can do the same thing with an income statement. Now, with an income statement, everything is calculated as a percent of sales. Okay. So, for example, you could look at cost of goods sold. 83.4 went up a little bit in 2016, went down or expected to go down in 2017, which is good, but the industry average is still, which is actually, the industry average is 84.5, so this is actually even better than the industry average. Okay. So if you do convert the information into common size numbers, the advantage is you can compare across years and also compare to an industry average. Okay. Another method, perhaps not as widely used, is a percent change from year to year. Okay. So again, this enables you to see which items on a balance sheet or income statement have gone up, which items have gone down. Okay. Same thing for, obviously, assets and liabilities. Now, the DuPont analysts, again, as I mentioned before, they made up a system for evaluating company performance using financial ratios. And in their system, ROA and ROE are the two most important ones you look at. So one thing they did do was decompose ROE. Now, ROE is basically net income over common equity, but here they defined it as the product of three ratios. So you have profitability or net profit margin, you have total asset turnover, and you have something called the equity multiplier, which is actually a sort of a debt management ratio. And so one advantage of looking at ROE in this way or calculating ROE this way is you can determine which factors contributed to return on equity in what way. Whether was it profitability, was it debt management, was it asset management? Okay. And okay. So just an example, you're looking at 3 years of data, and when ROE is decomposed into these 3 component ratios, you can see how each of the ratios or each of the areas contributed to the company's overall return on equity. Now, obviously, this assumes you're doing a very thorough analysis of profitability, and you would like to know which factors contributed to perhaps a change in profitability over time. In this case, we're looking at ROE. Okay. Okay. Now, your book has a nice long section on this, limitations, potential problems, limitations. Basically, you have to remember that when you calculate ratios, you are using numbers provided by the management of the company. Okay, you're using balance sheets and income statements, which were prepared by management, and management will often do what's called window dressing. They will massage the numbers, make the numbers look as good as possible. You also need to be aware of seasonal factors, seasonality. Obviously, if you're dealing with companies in different countries, sometimes different accounting practices will also make the comparison hard to do. And of course, sometimes it's hard to get industry averages or benchmarks, especially if you're dealing with a multi-industry firm. And many large corporations are multi-industry firms, okay, different divisions with many different divisions. Okay. Oh. And one final comment, the number crunching obviously is important, but you do need to know that there's more to the firm than just numbers. Okay, so you do need to look at qualitative factors also, not just quantitative factors, but qualitative factors. And so, some of these are listed here, but obviously, you need to look at the reputation of the firm, the quality of management, quality of the people working for the firm. Those are things you cannot quantify. Okay, so the number crunching is helpful. It will help you evaluate performance, but you also need to look at qualitative factors. Okay. So, again, ratios are very easy to calculate, but they can, if used properly, tell you a lot about the performance of the firm. So what I would like to do next is perhaps, actually we'll work on some of the problems at the end of the chapter. Now, I don't want to do too many problems, okay? You do need to work on them on your own, okay? You will then learn a lot more. I mean, if you see me doing them on the board, doesn't really, you see me doing them, but you actually need to think and work on them yourselves. So let me do a few in class. Okay, we'll do a few in class tonight, and then I'll let you go. Yeah.
Will the recommended problems cover basically everything that would be on the test, or was it just like outside of the working on the problem?
No, they will cover what's on the test. But let me make one comment. If you look at the problems, your textbook typically divides them into 3 types, easy, intermediate, and challenging problems. So on the test, you are not going to get challenging problems. Okay, the challenging problems are pretty long and complicated. Okay, so there might be an exception or two, but on the test, more likely you will see intermediate and easy problems. So if you can do the intermediate and easy problems, you should be able to do the test problems. However, depending on the chapter, there might be an exception or two. But yeah, okay. So my plan for today is to do a few of the problems, and I'll let you go around 8:20. Okay, I'll let you leave around 8:20. But I would like you to work on all of them on your own. And of course, next week in class, if you want, we can certainly go over some of them also, go over some of the problems in Chapter 3. So next week we will do Chapter 4, but we can also we'll also have some time to go over Chapter 3 problems if you want to do so. Okay. Now, when you're doing the test for Chapter 3, make sure you have all of the ratios listed in your cheat sheet or on your page of notes. Okay. So most of the ratio problems on the exam are similar to the easy problems, what your book calls easy problems. So, well, let me just start with the first one, and then we'll do a few more complicated problems. Okay. Now, because this chapter deals with ratios, obviously you are going to need financial ratios to do all of the problems. So, first one is a standard example. They tell you the Green Sisters Company has a DSO of 20 days, average daily sales of 20,000. What are the level of accounts receivables? Assume 365 days in a year. Okay. So with the financial ratio problem, the first thing you should do is write out the ratio and see what you do know and what you do not know. And okay, so the standard definition of DSO is your accounts receivable balance divided by daily sales, or average daily sales. So you need to write out the definition of the ratio first and then see what numbers we can plug in. So in this problem, they tell you DSO is 20, receivables are 20,000. Oh, sorry, not receipt. Okay, so sales are 20,000. Oh, average daily sales are 20,000, which means they have already calculated, taken total sales divided by 365. Okay, so write out the definition for the ratio, plug in the numbers which are given. As you can see, the unknown happens to be receivables. So 40,000. Right? Okay, so this is a pretty standard financial ratio problem. Sorry.
400.
Oh, Mr. Zero? Yeah. Thanks. Okay. Any questions? Okay, let me do another one, maybe 3-3. So, problem 3-3, they give you some information about a company. We are given stock price, total assets, some balance sheet data, and we are asked to calculate the market to book ratio. So, basically market value divided by book value. So, what is the market value of the company? Or how do we calculate the market value of the company?
Price per share times common outstanding stock.
Okay. They do tell you that the stock price is $75. And how many shares are outstanding?
800 million.
800 million. Okay. So that's the market value of the company. Stock price times number of shares outstanding. Okay. And what's the book value of the company?
$6 billion.
Okay. Yeah. Remember, on a balance sheet, you have current assets and fixed assets on this side. On the other side, you have current liabilities, maybe long-term debt and equity. Okay. The two sides of the balance sheet. This is the book value of the company. Right? Okay. Which they tell you is 6 billion. Okay. So convert it into millions, that would be 6,000 million. So the market to book ratio is how much?
10?
Okay, so you've got 10. Can we get a confirmation? Yep, okay. Book value. So market to book value is 10.
So the ratio in the book says market price per share, it's the same as the market value.
Yeah. I mean, you can do it on a per share basis. So if you're doing it on a per share basis, you would take the stock price.
Okay.
Yeah. So yeah, you can do it on a per share basis or just take the aggregate amounts.
Okay.
Because what you want is the ratio, so yeah. Okay. Well, let's do 3-4. So they tell you that a company's earnings per share are $1.50. Cash flow per share $1.03, and price to cash flow is 8. Okay. What we need to figure out is the PE ratio. So, how do we do this? Now, with ratios like this, there are quite a few ways to use them to get the answer. Here's one way. There are quicker ways, but this is one way. Remember the equation I had up, market value ratios? So one way to look at stock price is to do cash flow per share times price to cash flow. This would be one model of stock price. So because they give you cash flow per share and price to cash flow ratio, you can use those numbers to figure out what the stock price is. Okay. So 3 times 8, stock price of 24. Now, another way to define stock price is as the product of earnings per share times PE ratio. Now, here we were given cash flow per share and price to cash flow ratio, so we could calculate stock price. Here, we know the stock price. Do we know EPS? EPS is given, which means we can figure out what the PE ratio must be. So PE ratio, 24 divided by $1.50. Once again.
16.
Okay. Oh, one thing I forgot to do was pass out the sign-up sheet. Please sign next to your name. Okay. Now, obviously, there are quicker ways to do this, but I thought I would show you how these ratios are related. Okay. So, again, with financial ratio problems, it may not be immediately obvious how to proceed. I would recommend just write out the ratio, plug in numbers, and since this was given, we use those two to get the stock price, and then use the stock price equation here to figure out P ratio. So again, you may have to work on it a few different ways before you can figure out the unknowns. And that's going to be true for most of these problems. It's not immediately obvious how you should proceed. Okay, but my standard recommendation: write out all the ratios that are given, or equations that are given, plug in numbers, and then see what you can solve for. Okay. So you do have to think. You do have to think a little bit to get the answer. Okay, let me do one more problem, and then I'll let you go. Let's do problem 3-9. And again, I don't want to do too many problems on the board tonight. You do need to read the chapter carefully, take notes, and work on the problems yourself. But if you have any questions, we can certainly do a few more next week. We will have time to do so. So let me do one more, and then I'll let you go. Problem 3-9. Okay. So you're given a company's current assets and current liabilities, and also levels of inventories. They tell you the company is planning to borrow money as notes payable and use it to increase inventory. How much can they borrow without pushing their current ratio below 2? Okay. The current ratio is the liquidity ratio. It's always calculated by taking current assets, dividing it by current liabilities. So how much does the company have in current assets right now? $1,312,500. Okay. And right now, current liabilities are $525,000. So the current ratio right now is 2.5. Okay. Okay, so right now they're at 2.5, but the restriction is that they can borrow money, but this cannot go below 2.0. Okay, so what they want you to do is figure out how much you can borrow. Maximum amount that can be borrowed in the form of notes payable. By the way, what kind of liability is notes payable? No, usually it's short term, so current liability. Okay. So here's what will happen. If they borrow X dollars, current liabilities go up by X dollars, whatever X happens to be. We have not solved for that yet. Okay. Now, what do they plan to do with the money? Yes, increase inventory. And remember, inventory is current asset, which means your current assets will go up by the same dollar amount. Okay. So they borrow X dollars in the form of notes payable, which is a current liability, and then they buy it, and then they use it to buy inventory, which is a current asset. So both current assets and current liabilities will increase by the same dollar amount, which we have to find out. So if they borrow the maximum amount given this constraint, they should be at exactly 2. They cannot go below 2.0. Okay. So using the formula or definition of current ratio, we can create an equation with an unknown in it, and since there's only one unknown in the equation, we can solve for it. Okay. So current assets go up by X dollars, current liabilities go up by X dollars, and the most you can borrow is what will take you to 2.0. Any more, your ratio goes below 2.0. Okay. So now that you have an equation, you need to simplify and solve for X. So after this, there are many, many ways to do it. Here's one way. Right, this is one way to proceed. Obviously, there are many ways to do this. Okay, so this becomes 1,050,000 plus 2x. This is still 13125 plus x. It's customary to bring the x's to one side, everything else to the other side. Okay. All right, so x is
Yeah, 131,250.
no, that
262,500.
okay. 2625. Yeah, because 1.3 million minus 262.5. Yeah. Okay. So that's the maximum amount you can borrow without going below 2.0. And in a problem like this, where you're solving for an unknown, one way to check your answer is to plug this number back in here and see if you get 2. If you do, then you have solved for x correctly. Okay. And I think one more thing they want you to calculate, quick ratio after they have raised the maximum amount of short-term funds. Okay, so quick ratio. Okay, so quick ratio is current assets minus inventories over current liabilities. Okay, this is another liquidity ratio. And so this is after the company has done all of this. So company's current assets were 13125. They have now purchased $262,500 worth of inventory. Subtract inventories, which are, what was the initial level of inventories? 375. Okay. And current liabilities used to be 525. Now we add 262.5. Okay, and the quick ratio is Next week, make sure all of you bring calculators with you. We'll be doing lots of problems in class. Okay, so what's the quick ratio? 1.5? 1.52? Okay, let's get a confirmation. Same answer? Okay, everyone got the same answer? Okay. Yes, no? Alexander? Same answer? No? What do you have? 1.19? Okay. Okay. Okay, so since three of you have 1.19, I'll assume that's the correct answer. Okay, so, this is a financial ratio problem, but this required a little bit more in the way of calculations. And this is actually a very common constraint placed upon companies by lenders. So when companies borrow money from a bank or financial institution, obviously a loan will have many covenants or constraints attached to it. This is a very common condition because what the lender wants to do is make sure that the company maintains a certain amount of or certain level of liquidity. Okay. So again, so this is very common situation. All right, let me stop here. I would like you to work on the other problems on your own. Make sure you can do all of them. Okay. And on the exam, there will be lots of problems. So most of them will be similar to, I guess, the first 10. On the exam, there are none of these longer challenging problems. Okay, so please make sure you do the problems, and next week we will do chapter 4. You have to read the chapter before you come to class. You don't have to do the problems, but you have to read the chapter. So in class we will do lots of problems. Please bring your calculators and the textbook with you. And if you like, we can also do some problems from chapter 3 next week.